Imagine a financial system where money is created out of thin air, where every dollar you deposit, every loan you take, and every interest payment you make quietly fuels the wealth of the few while leaving the many unaware. And this system, fractional banking, has been shaping economies, creating crises, and concentrating power for centuries. It all began in 17th century Europe when London goldsmiths realized that most depositors never withdrew their gold, so they issued promissory notes far exceeding their actual reserves, effectively creating money on paper while lending it at interest. And as nations industrialized, banks grew into central pillars of national economies, formalized by institutions like the Bank of England and later the Federal Reserve, expanding credit exponentially but embedding structural inequality. Because while banks and their owners profit from interest and the multiplying effect of fractional reserves, ordinary depositors bear the risk of defaults, inflation, and economic downturns. And history is filled with repeated patterns, from John Law's early experiments in France to the Great Depression, the savings and loan crisis, and the 2008 global financial crisis, where system failures triggered massive losses for the public, yet bailouts and emergency measures rescued banks and preserved their control, a cycle reinforced by modern financial innovations such as derivatives, mortgage-backed securities, and shadow banking, which conceal risk and amplify profits for elites. And today, even as you watch this, trillions of dollars are circulating in ways that ordinary citizens cannot access. And the evidence is stark. Wealth concentration has reached levels unseen in centuries. Household debt is rising globally, and central banks' policies ensure liquidity flows primarily to financial institutions rather than average savers. The story of fractional banking is therefore not just about money creation, it's about power, control, and the subtle engineering of wealth inequality. And the lessons are clear. Understand where your money goes, recognize the hidden structures that amplify wealth for the few, and never assume the system is neutral, because every crisis, every bailout, and every interest payment reinforces the same historical pattern. So the three takeaways are: 1. Money is not neutral. It's a tool manipulated by those in control. 2. Debt and credit systems concentrate wealth quietly over time. And 3. Financial literacy is essential to protect yourself from hidden systemic risks, leaving us with a final thought. The next time you deposit your paycheck, take out a loan, or hear about a central bank stimulus, remember, behind the numbers lies a centuries-old mechanism silently shaping who wins and who loses. And if you want to take real control of your financial future, you must start by understanding the rules of the game and the secrets they don't want you to see. So watch closely, question everything, and subscribe to continue uncovering the hidden truths of money, banking, and global wealth.